Um, so I've had an opportunity to speak to Kelly on a couple of occasions prior to today, and just feel blessed and full of gratitude to have her kind of walk into our lives and really learn a lot about the phenomenal work and space that she's in, and just also a great human being. And so Maria and I, in preparing for today, came up with some questions, and we will open it up to the audience as well. And so, Maria, why don't you kick it off with the first question, and we'll kind of just make it a very casual, informal conversation piece, which I think will make it very rich and interesting through that.
Okay, sounds great. Yeah, so we're going to start off with a quick background about you, Kelly. Where were you born, and what was your upbringing like? And then maybe segue into like your college experience.
Sure. Hi, everyone. Thanks for having me. Really excited to be here. Great way to break up the day. You know, always excited to sort of be in and around entrepreneurship and certainly aspiring entrepreneurs. So pleased to be here. In terms of my background, I was born and raised in Massachusetts. I kind of classic middle class Norman Rockwell suburban upbringing. I was the first in actually my entire family, my mom's side and my dad's side, to go to college. My dad spent 34, maybe more years at Polaroid, kind of, you know, went to school nights and, you know, did his best to kind of further his skills and his education and provide for the family. And my mom, you know, stayed at home with us kids. So for me, it was, you know, I was around, I think it was always really inspired by my dad's sort of work ethic. And, you know, there was a focus on kind of earning it. That was the theme and the spirit of, you know, what our parents kind of passed on to us. And I think, you know, I had that work ethic from a very young age as a student, and, you know, and then on to college and thereafter.
So what was your mindset like? Like, what was your mindset after college? Like, what did you do?
You know, college, I thought I wanted to be a vet, like a veterinarian, and I went to school pre-med. I went to Michigan State. I grew up in, you know, kind of a small provincial town, so wanted big sports and the full college experience, and quickly learned that, you know, I was pretty overwhelmed by the course load of being pre-med as a freshman, and there was so much more I wanted to take advantage of being in at such a big school and so far away from home. So I switched majors to comms, and that made things a little easier, and I was able to kind of take part in everything that you know, that interested me and the school had to offer. So when I looked to graduation, you know, I thought, oh, well, I definitely want to go back to Boston. I want to, you know, the only thing I aspired to was, you know, get a job in something around comms, but I wanted to be in tech and I wanted to be close to product. And I used PR and communications as a way to have that kind of access to people who built products and positioned products and sold products, software products into the market. So it was like, get a job in tech and live in the Back Bay in a brownstone. Like those were those were like the things. So I did that, and I worked at a couple of agencies, like PR agencies, doing public relations with tech press and industry analyst relations, and kind of parlayed that into, it was great being a consultant, having multiple clients, access to entrepreneurs, startups, and interesting products and interesting product people. but as a consultant, you're not really in it every day. And so I had the opportunity to go in-house at, one of my clients, which was Lotus, and play that role there. And then, was at Lotus and then IBM for about 6 years, and was able to kind of navigate that organization and move into the product side of the business. I held, the PR role originally, and product roles, marketing strategy roles. And that was kind of where it was a large organization, but there was a lot of intrapreneurship in the company that I really enjoyed being around. And I was always part of launching a new division, a new product set. And that was really exciting. So I found myself being drawn to earlier stage builds. And that's where I kind of got the startup itch and wound up leaving IBM, for my first startup. But all in and around, the Boston area was kind of where I cut my teeth on this desire to build something. And frankly, since then, I've never held a job that anybody has held before me. I've never been the entrepreneur, like the one starting the business, but I've often been the number two. And in one case, which was kind of a sabbatical from my tech career, I built a wine business, and it wasn't my idea, but I was the CEO and ran and built that business. So it felt like my own. But it's all of these businesses have felt like my own. And even as an investor now at our firm, I'm one of seven.
So before you get to that, I have a follow-up question. So what time frame was it when you left IBM to the startup side of things?
In the year 2000, while everybody was doing or suffering through the dot-com thing, or about to suffer through it, I joined a pre-revenue, totally stealth startup before we didn't launch until 9 or 10 months after I joined the business. And that company was called Groove Networks, and it was founded by Ray Ozzie, who invented Lotus Notes.
Oh, wow.
Yeah.
So, wow. So you were like right there working with the inventor of
Ray.
Lotus Notes.
Yeah.
I mean, that's a story. That's a book right there. That's a story.
Yeah, it was amazing. He's an incredible mind, innovator, entrepreneur, and human being. He's incredible, and attracts really, really incredible people. So it was a really great time, and great team. And we attracted a lot of capital. We had decent growth. We sold to Microsoft in 2005. So it was my first startup and my first exit.
That's awesome. When we're done with the talk and we go into Q&A, there's someone you have to meet who's I see is on the call, Theodore Weitz. And I'll mention the interesting connections towards the end. So you'll get a kick out of this.
Cool.
All right, Maria, let's move it forward. Oh, you're on mute, Maria. Sorry.
You had this early success, right? You had a startup and your first entrance and exit. Kind of what did you do afterwards, and when did you realize that you first wanted to be an investor instead of just someone that was working in startups?
So my career, I guess, post IBM was pre-revenue to $100 million in revenue, largely tech companies, except that stint building a wine business. And, they were all high growth, reasonably capital efficient, technology companies, mostly software. And as I think I mentioned, I was always in a job that nobody held before me. I was helping build a business, doing something innovative, but I was also, I've always created the job that I landed in. And that seemed to be important to me over time. I don't think I asked for it that way or expected it that way, but that has been a pattern. The investor thing, it sort of just happened to me. I think I worked inside companies that look a lot like the companies Edison invests in, and was an operator and have a vast, set of experiences as an operator and an executive in high growth companies. So Edison was actually an investor in one of my former companies, operative, and I reconnected with our managing partner in 2000. I guess it was 14 when I moved to the Princeton area, and I had forgotten that they were based here. And he said, we're raising our next fund, and we're starting to think about evolving from a venture capital strategy to a growth equity strategy, and we think we need more operators in the firm, to help power that. And I thought, oh, a job that nobody's held before me, and working with people that I'm, really I have some experience with, and also having raised a lot of capital and been around boards and investors on the inside of companies, I really didn't know what it was like working at a firm, and how to think about capital allocation and portfolio management and different exit strategies. And there were just so many things about being an investor that you think but you really don't. And so that was interesting to me, because even though it was in an industry where I was comfortable and I knew I had a lot of experience to bring to bear that the firm would value, there was a lot I didn't know about this particular part of the industry. And so I was excited to learn, to continue to learn. They invest, Edison then and now invests in fintech companies, healthcare tech companies, software, enterprise software companies. I was very comfortable with those sectors and the business models. So there was enough familiarity. And then becoming an investor, I was there to help create value initially and build out a platform, an operating platform, as value add and resourcing for our companies that we back. I never thought I would enter that firm and then become an investment partner in that firm. I thought I would just keep building out this Edison Edge platform, and if it was working, then we'd bring on more resources, and that would be what I would do. So I kind of got pulled over. I'm sure it was my choice, but it feels like it just kind of happened to me, where I inherited boards. I was kind of exit girl for a while, where I was taking over some boards and readying the company for sale. And then I started leading investments, and it's great to wear multiple hats. It's a small firm with a really now interesting mix of lifer investors, folks who've been doing this their entire career, and former operators who are now investors. So I was the experiment in the first, the first, but there's been others that have followed me, some of my partners. So it wasn't I wasn't deliberately trying to be an investor. I think I learned by osmosis, and frankly, my entire career has been osmosis. I never even took a finance class in undergrad.
That's interesting. Just to go a little deeper on one thing you talked about. So you were a co-founder and or early employee or part of the executive teams, the C-suite, or the operating team in a number of tech startups in your journey. Can you briefly just share, if you're able to share, how much money was raised through VCs for those companies, and if any of them exited ultimately, approximately order of magnitude of exit valuations versus the amount of capital raised? Just trying to give the audience a little bit of perspective on some of the examples or numbers, if you recall any or if you can share any.
I mean, there were, $10 million raised, $50 million raised. There was one company went public very early, and hadn't really raised outside capital before doing that. And so there wasn't really a fundraising dynamic. When I joined, we were a public company, but we were only, 40 million in revenue, and still figuring it out, like how we were going to scale growth, and very lean. I think, most of these companies, 3x returns, 5x returns. One company has not exited yet, has probably raised 40-50 million bucks, and is about the same size, generated about as much revenue as they've raised, and should have a good outcome. No company raised less than 10 million. But all of them wound up generating, with the exception of Groove, my first startup, wound up generating more revenue than they raised in capital. And as an investor, that's something we really like to see. It shows, it's a signal of capital efficiency. If you can make that happen. It's not as popular a view by many investors who might have a little more of a growth at all costs kind of venture mentality. And I think my first startup was a little bit of a growth at all costs. And we were just going after a really big set of things. And in hindsight, we probably could have done better at choosing the things we were not going to do.
Interesting.
So I was thinking, that kind of reminds me, are there any like do's and don'ts for someone that's kind of initiating a startup? Like our theme is the smart startup, right? And what investors are looking for. So what are some smart things that people can do or avoid, like in the beginning stages, when they're thinking these things through? I guess there's probably a process, since you've been around this for a long time.
Oh, there's so many. I would say, from a capital formation perspective, don't ever raise more money than you need. Okay. I think that can create some potentially bad behaviors, or bring on more risk than you need to accept, particularly at an earlier stage. I think about people in team a lot. If you're the one starting it, like, be really honest, look in the mirror about who you are, what your skills are, what you're going to bring to the table. And in the beginning, who's your, hire for your gaps, right? Like, even if you're just looking for a number 2 or the 3rd or 4th or 5th person for your organization, like, it really has to be all about, there's kind of your gaps first, and grit. Like, you got to be gritty. Everyone around you needs to be gritty in those earlier stages. Having smart people around you, the IQ part is always key, but you're also at a point where you're trying to improve product market fit, and you really want to be having as many conversations as possible and get as much validation from customers as possible. And as the leader or the founder, you're probably doing a lot of that yourself. But when you think about hiring for the team, there's EQ and salesmanship and
Right.
personality that can be out in front with you or in place of you,
Mhm.
and or in place of you, is, I think, is really, really important at an early stage too, because the people who are going to give you your time and give you that honest feedback, like, it's some reciprocation off of the vibe they get from you, no matter how incredible your idea is and your product is. So the money is like a hard piece, and the hiring piece and the team, forming the team and the company building piece, there's a lot of soft pieces that go along with that. And then third, I mean, the whole fail fast, like, just experience, like, have a stake in the ground around metrics that you're trying to achieve. And they can be really tactical, like usage in technology. It's like users or usage. Getting a user is great, but are they using it? The usage. How many are you going to have by when? What does a healthy, active, valuable customer look like? How many of those do you need to feel good about investing further and moving on to the next stage? Like, find these little tactical metrics and build your business around them, kind of from the bottom up. And you'll be wrong, but you'll set the goals. You'll see if you achieve them, how long it takes to achieve them, and it'll inform you how you continue to roadmap your business thereafter. Just being really iterative and okay with failing, and kind of that intelligent speed is what will propel you and help you really figure out if what you've got is ready for acceleration, ready for capital, ready for more people around it, if that makes sense.
Okay, yeah, no, I think that's really great advice, because I think a lot of people just kind of are so passionate about their idea, and sometimes you don't see the forest for the trees, right? So, like, what level, like high level advice would you give to maybe our current students who haven't even gotten their feet wet, but they're aspiring to be entrepreneurs?
Well, there's a notion, it's funny because I talk to so many entrepreneurs who, like, I was on this judge, kind of investor panel for Wharton last night, actually. And there were a lot of business school students who were presenting ideas, new businesses. Some of them are actually generating some revenue, or raised a little money, or just starting to raise money. And one thing I took away from that is it was so clear that they were all super passionate about the idea. Like, they were the customer, or someone close to them inspired it because, they had some special knowledge or some problem or what have you. So you need to have that passion and have some connectivity in some way when you pick your thing. But on the other side, and I see more of that than I see passion that comes from just a really thoughtful look, like maybe it was curiosity, or something that drove you to really look at a market or recognize a problem in a market, and it's not connected to you, but it might be an aha, or it might be an experience that you've gone through. And you don't have to know so much about it. If you're curious and driven and you really think it's a big enough problem to solve, then there are plenty of entrepreneurs who've gone at it that way. And it's funny because in healthcare technology companies where we invest, it's more often than not, when you're talking to these CEOs and founders, they're like, oh, my grandmother, my mother went through this, and it was, the experience was horrible, or this was ridiculous, or it took too long, or whatever it was. So it was something very close to them around, the personal lives and where healthcare intersected there. But once in a while, you hear about the entrepreneur that just said, you know what, this was just a really big market, and it seemed ripe for innovation, so I just went for it. And that's okay too, right? So, I think the passion, and whether it's the passion that stems from the intellectual curiosity around a big market or some opportunity that you're just learning about and want to go after, versus the one that's, connected. I don't think, it has more personal connectivity. I don't think it matters. But I think being really passionate, becoming expert, is like job one, right?
Yeah, absolutely. So we heard a little bit about your announcement beforehand about you closing on a house, but as far as so congratulations on that. But what are your future aspirations, I guess, as an investor or even as an entrepreneur? Do you think you'll go into entrepreneurship again? Do you think you'll continue as an investor? What's in the future for you?
I think this is probably it. Like, I don't know. I mean, I'm never satisfied. There's always something, but
there must be that one more company in you that you've said to yourself, one day there's got to be, because I know entrepreneurs who are serial entrepreneurs, you can say you're happy and et cetera, but you're not going to be satisfied.
Yeah,
I'm sure there's one more company in you.
Everybody thought that about me, and may still think that about me. Like, oh, she'll go back to operating. But you know what? What we do every day is help entrepreneurs' dreams come true. Like, it sounds so cliche, but like, we live and invest, and our customers trust us with their money to invest to make that happen. And I have this broad portfolio of different stages, different sectors, different problems and opportunities. Like, I'm getting it in spades. I'm just not the one running the business day to day. And my nature, because of my background, like, I have real empathy, and I've walked in these shoes, and I think I have a different kind of connection with, and any of the former operators, recovering operators in our firm, has a different kind of connection and conversation with the founders and the management teams of these companies, because we've been there. So I'm fueled by that every day. And there's so much dynamic and diversity in the work that I do that, I think I can't imagine at this point, it hasn't even really occurred to me to go back to an operating environment. There was actually one company that it's actually Billtrust here in New Jersey. Chris Sugden, our managing partner, led the initial investment. He was on the board for 11 years. The CEO, Flint Lane, asked me to join the board. This was like 3 years ago. And we were just getting ready to sell our ownership. So I was on the board for a little while, and actually spent a lot of time in the business. Like, they live right down the road. I mean, their office is right down the road. I live nearby. So I was in the business for like 4 months, 3 days a week. And when it came time to roll off and go back to being board member, I struggled a little bit with that. Like, I loved that culture, those people, that company. It was the first time in now my 7 years investing that I had a little bit of an itch and FOMO for going back to the board seat. And I mean, we had a lot of impact there at the time right before we exited, and it was 11x return for Edison. We were in there for a long time, but that company's now public. doing incredible things, stocks performing well, management team all became millionaires, like with the IPO. And, it's exciting to think Edison had something to do with that from very early on, but I loved being a part of that inside the business, but still look back on it and am proud of the work we did as investors and as a board member in that business as well,
I have a quick follow-up question to go a little deeper on two metrics that you mentioned. As a VC, well, before that, how large is the current fund? How many companies in your portfolio, your personal portfolio, that you kind of touch or see or give oversight or feedback or interactions? And what's the approximate average deal size or range, even just at high level? And then after that, what are the return expectations in terms of either multiples on investment or and what kind of time horizon expectations?
Sure. Yeah.
Just so that people who are not so familiar with the VC space can at least understand those metrics from your lens.
Yeah, sure. So, and I'll start with, so there's venture capital, and then we're now growth equity investors. We are in the process of raising our 10th fund. We just had our first close. And that fund will be, our target's 425, our hard cap's 500 million. Our prior fund was 365, at fund 9. Fund 8 was 275, right? So these are the largest funds we've ever raised. Prior to fund 8, we were venture capitalists. So our funds were a little smaller. We wrote smaller checks into more companies. With growth equity, we're writing larger checks and we have more concentrated portfolio. So in fund 8, 9, and 10, anywhere from like 17 to 22 companies for fund of 275 to 500. And we become more concentrated over time. So the companies at the time of investment with the venture strategy from our first 7 funds might have been like 2 to 5 million in revenue. With our growth equity strategy, 8 million would be kind of an entry point. I think we've made some exceptions where we might go down to 6 or 7. And we're putting, we're taking 15 to 40% ownership in our minority investments. We will do control deals, but we're not a buyout fund. This is all growth. If in our new fund, we might do 2 to 3 majority investments. But these companies are, 8 to 30 million in revenue. They're growing, we say at least 30%, but our current active portfolio at the time of investment, they were growing an average of 130%. We are often the first institutional capital, but if they have raised capital prior, they've usually raised on average less than 5 million. And that really goes to that point I made around, can you generate more revenue than you've raised in capital? And that won't be the case necessarily out of the gate, but as you get some scale going and start to accelerate growth, hopefully, that is a metric that you can aspire to. We hold company. So when we underwrite an investment, we'd like to get at least, a 3x return.
And how does that compare to the VC, early stage VC?
Kind of like 3 to 5x return. Well, here's the difference too. With growth equity, more money to work, more concentrated portfolio, slightly more mature companies, so less risk. Mm-hmm. And the return multiples might be a little lower, like 3 to 4x, but your dollars are higher. So we might get like 50 to $100 million in proceeds in an exit versus, and we get that from half or more of our portfolio companies in that fund. With venture, most VCs are happy if one company returns the fund.
Mhm.
So you make a lot of bets, small checks, lots of risk. You've got usually some market risk, definitely product risk, and definitely execution risk. With growth equity, we are not taking market risk generally. We're not taking product risk. The product typically feels more mature than the business. At the time of investment, it's been customer funded product. There's repeatability in terms of selling the same thing to a customer again and again, to the same type of customer. And we take execution risk. But there's some repeatability in the business. It's ready for scale. It's no longer testing. So with VC, you might get 10x your money, 15x your money, 20x your money, but it's small dollars. And you're not with a big portfolio of, $150 million fund with 30 companies, maybe more.
Yeah.
Like you're kind of just hoping one or two really hit it to return the fund, because there's going to be really high losses. And growth equity, like our losses, meaning we get less than 1x return on our money, is under 15%. And VC, it can be, 30, 40, maybe even 50%.
Wow.
Got it. With the early stage VC, the typical deal size you said was maybe 2 to 5 million approximately.
Yeah, the revenue might be 2 to 5 million. The checks, our checks were smaller, but certainly there are venture capital firms that write bigger checks into very early companies, but that's not how we roll.
Right. And what was the typical equity position for small checks in a lot of companies in the early stage VC
So in the
stage?
early stage, it could be 20, 30%. And we have some companies where they're more mature, and we might accept 10% ownership, but still we're the lead investor, we lead the round, and we might stage in our capital over time. VCs will do their pro rata on the second round, third round, fourth round, and maybe not even participate. They try to get as much ownership up front. And the first money in is really that first check in is really what's most important for us. The way we land that investment and do that first investment will be sizable, but we do staging capital, and, we may put up to $40-50 million into a company that's really performing over time. And when you look at our last two funds, we have several examples of that. And ultimately, at the end of the day, we want to deliver to our customers, the folks who invest in our funds, a 2.5 to 3x net return, like net of fees, our fees. And the return on the money on invested capital, the MOIC, is, let's say 4x. So that's.
And how does that compare to an early stage VC?
The numbers are higher. They need to be higher. But a 3x net fund is like a top quartile, if not in some vintages, top decile performance for a growth equity firm.
Excellent. And I like the point you made about former founders and operators and owners being VCs, because they have this empathy, and they become founder friendly and more supportive because they've been there. They've walked in those shoes, in those journeys. So thank you for sharing that.
Yes, thank you. Thank you very much for joining us today, Kelly. So I think we're going to open it up to some questions here. We have about 15 minutes remaining. And first off, I wanted to unmute Nikita. She had a question for you. Nikita's still here. Let's see.
Yep, and then I'll introduce you to a good friend, Ted White's, in a moment.
Ryan, could you unmute Nikita for me, please?
We're over a year in and this stuff's still happening, right?
Yeah. I know. It's so hard. You forget who's hosting.
It's been such great information. Kelly, thank you so much. Question, for a startup, what are some of the common mistakes that you see that will completely turn a VC off? Like, what are some common mistakes that you see startups make?
Good question.
Oh, how much time do you got?
Top three.
This, like, just off the top of my head, this isn't a playbook per se, right? Like, or something, I could put more thought to it and I might have more intelligent response. But if you're revenue generating, you do not position yourself as generating revenue that is cumulative since you've been generating revenue. Like, you have this is, your quarterly financials, your month-to-month financials, your annual financials. It's pretty basic, but there's so many companies and CEOs, even when they're just pitching, like, we've generated 10 million in revenue. Well, guess what? The business has been around for 10 years, right? It's not 10 million in the last 12 months, right? That makes me crazy because eventually I'm going to find out. Like, we're going to see. So like, just be really cards up about your numbers and know your numbers. Another example, if there's something sketchy that happened in the business, whether it's like, you made a ton of mistakes and you pivoted, and you want to forget that it happened, embrace it. Show that you're a learner. Don't hide it, because again, it's going to come out, and be cards up about it. I mean, we've had CEOs or founders say to us, I just ran into a similar situation recently. And I had a hard time getting past it because it wasn't brought to my attention out of the gate, and the founder wasn't cards up with me, and I had to go find it out and then approach him. I don't even care what happened in the past. Ancient history, people deserve second chances. It was that you didn't bring it to my attention. So we've had folks come to us and say, here's why you don't want to invest. You might not want to invest in my business. Like, I've pivoted this company 4 times. We failed at this, we failed at that, but here's what I've learned, and now we're moving forward, and this is why you want to be a part of this journey, right? Like, just own it, and be really cards up about it. I think everybody thinks they need to paint this like perfect picture. And then the third thing I'd say is, and this is really important, it's a two-way street. Don't feel because you're raising money, you need this money to take your business where you want it to go, that you need to be the only one in sales mode. And that, I think it is very much, and I expect this now, and if I'm not given the opportunity to pitch Edison, share about our team and how we think and our philosophies and how we work, and why we might be a great fit for this business. Like, if I'm not asked to do that and to sell the entrepreneur, I will put time on the calendar to make sure I'm selling the entrepreneur. Because so often the entrepreneurs, like, I'm raising money, I need to convince them to give me money, and they think it's really just this one-way street, and the only thing that the investors need is to get their questions answered and the data for diligence. That is not the case. Like, it has to be a fit. You're going to be, it's almost like a marriage. Like, we talked about, we didn't really get into the whole period, but we're in these companies from 4 to 7 years typically, and sometimes it goes longer, and the fund life is 10 years. So and you don't know what the twists and turns in this business is going to be. There's going to be highs and lows, and the people that are around you, not only to help you, but like that you just want to work with and figure out the hard stuff with. It requires that both sides are selling, and it requires like a really good fit. So don't ever feel like that it's a one-way street, and make sure you're making it a two-way street, and the investors will appreciate that.
Thank you so much. Very, very insightful. I appreciate your candidness.
Yes, I tried to capture some of the key highlights of her responses in the chat box for up to now. So yeah, it's tough keeping up typing. Great advice.
Fast talker.
So I did want to introduce you to Ted Weitz. He's a partner in a tech startup law firm that represents a lot of startups and emerging growth technology companies. He's also a professor at the Entrepreneurship Law Clinic at Rutgers Law School, and where we represent startups and give free legal services without charging if they qualify. And so, of course, anyone on the call today, if you have a startup and you have not raised a lot of capital or do not generate a lot of revenues yet, it's a clinic that we can provide as a resource. But just like you said, you worked with a co-founder or the inventor of Lotus Notes. Ted has a famous story of I think one of the first copyright things he did, and I'll let him mention that. But he also worked in the corporate venture capital space as well. So Ted, you want to just quick introduction, and if you have a question also.
You're on mute.
And I'm on mute.
Oh, okay.
And that comes up in every conversation. It's really sad how slowly we learn. I think what you're referring to, I'm not sure which story you're referring to, but I suspect it's when I was at Unix System Laboratories.
That's right.
And one of my claims to fame, such as it is that if you were to go back to if you were to go to the Copyright Office of the United States, I'm the person who registered the copyright for the Unix operating system.
Oh, wow. Claim to fame. Is that your only claim to fame? I'm sure it's not the case.
Oh, you're on mute again, Ted. Sorry.
There we go. No, that's not the only claim, but it's one. I've had a lot of interesting experiences. It wasn't because I had anything, by the way, to do with writing the Unix code. It's because I was a lawyer at Unix System Laboratories when we were about to sue BSCI, and you have to register the copyright before you bring a lawsuit. So
yeah, this is true. Yeah.
So
yeah, that's amazing.
I did that. But I also had lots of opportunities, including a great deal of one-on-one time with the person who's probably the paradigm of the entrepreneur in Silicon Valley. David Packard was one of my witnesses in United States versus AT&T, and I spent a lot of time with him. And of course, his investment of a few dollars with Bill Hewlett in a garage in Palo Alto was really very much the place where Silicon Valley, as we know it now, began, and is now on the register of historic sites in California as the birthplace of Silicon Valley. So I've had a lot of opportunity to deal with people through that.
That's amazing experience.
That's so cool. Yeah.
To be having worked with a co-founder of HP. I mean, where it started in Silicon Valley. Amazing.
That is amazing.
Yeah. So we have between Kelly Ford, who's a prominent VC and growth equity principal, and a former startup entrepreneur, tech co-founder, operator, and board member, to like someone like Ted Weitz. Like pretty awesome event here. Love it.
Yeah, absolutely. Thank you for joining us today. And Kelly, one quick question. Do you listen to podcasts, or do you have a book or something that you're kind of been into lately that you would recommend for anyone?
I don't have time to listen to podcasts. There's a lot of fintech podcasts whenever there's like, fellow board members or CEOs or any of my partners, or if I get roped into one, I'll listen to it. Yeah. Just related to our investment themes, but no, podcast, no. Book. I just started, and I'm gonna forget the name because I'm so bad at this, Adam Grant's new book.
Okay.
And I'm not gonna remember it, and it's in the other room. And there's another book that we actually we've shared with our CEOs, and I think for any entrepreneur, it's a super easy read, and I highly recommend it just in terms of entrepreneurial mindset. And as you think about building your business, building teams, and your, work with others, called The Coffee Bean. And Damon West is one of the authors.
The Coffee Bean?
Yes. And I'll leave it at that because I don't want to give it away. But
Okay.
it's so brilliant, and it's like far reaching in terms of applicability to our personal lives, our professional lives. And Damon West is a pretty inspirational character. If you Google him and watch some of his speaking engagements and his writings, he's pretty incredible.
And the book you mentioned from Adam Grant, is that Think Again?
Yeah, I think, yeah.
Okay.
Yep.
Yeah, I just included the link to his site in the chat. So anybody who wants to check him out, that would be great.
And I see Olena raised her hand. I'm not sure if she has a question.
Hi, Kelly. I have two questions. The first one is if you can share your perspective, what level of education is necessary versus experience or network to succeed in the VC world? And second question, if you can share any lessons learned, tough decisions you had to make at certain crossroads in your life, it will be great. Thank you.
Sure. So education to be an investor, was that the question?
Yeah, that's
Yeah.
right.
So you won't see an MBA on my resume, and we don't require it at our firm, but we have plenty of my colleagues certainly have gone to get their MBAs. As I mentioned earlier, like I got everything through osmosis. I, saddled myself next to the CFO, next to the general counsel, next to our, heads of sales, success, what have you, as an operator. And I think that served me well, because coming into an investment firm, I saddled myself next to my partners that knew things that I didn't know. And guess what? I knew things they didn't know. So, but I didn't learn it, when I work with our MBA, my colleagues that either fresh out of B school or had that business school experience and the internships at the investment firms and things like that. I mean, that's invaluable, and the connectivity and the access that you have. So you just have to decide how you prioritize. I mean, I had kind of a crooked path that got me here. I couldn't have come into this job 10 years ago, right? Like I got to a point in my career, and I've had enough of that osmosis, that I had enough context and experience to go learn this. But when we're hiring folks, analysts, associates, we have half of the Big 10 schools on our analyst and associate team represented, and they're all undergrads. And then, the middle of the organization currently is largely MBA. So it's just what matters to you. But I don't think it's required to have a career in venture or growth equity, nor is the investment banking stint, nor is the management consulting stint, which a lot of people think are platforms and launch pads, and it's not. Frankly, we'd rather you work inside a tech company and then come work with us. What was the second question? Sorry.
If you can share any tough decisions you had to make, any lessons learned at like some major crossroads in your life.
I would say when I left, I took a little sabbatical from tech and started a wine business. And I was there for 3 years. And I felt such ownership and responsibility to the team, to our distributors, to our winemakers. But I'd kind of lost the oomph for it, you know, like it was such a slog. I felt like I figured out the industry. I wasn't really going to learn more or figure out how to do things differently. The margins are so slim, so you can't be really creative in how you build the business. And the industry is so rigid and regulated that you were pretty limited. So the innovator in me and the person wanting to trailblaze and break an industry, I mean, we did a good job with what we could work with, but I was there was a crossroads there where I like, I owe it to all of these people to keep going. But my passion and my interests and where I was happiest in my career was working in this tech ecosystem and, you know, building, growing, scaling tech companies. So, so I, you know, made the decision to leave and go back to tech. And I think that was probably the hardest time professionally. Interestingly, and I'll add as well, because you have to do what's right for you. Another crossroads I was at, which I thought it was the end of the world, end of my career, was a company. It was actually the Edison portfolio company that I worked in. The CEO and I were not really jiving anymore. And I had such a pit in my stomach about that. Like, oh my God, I always get along with my colleagues and my CEO. And, you know, I mean, it was the first time I had like a true executive title in a business. And we had so many transformative things going on in the business that I felt I really contributed positively to. And he created a situation that was totally fabricated to when we should have just had a conversation that said, this isn't working out, let's part ways. And he did it in a way where I felt like I would have a black mark on my resume and I may never recover from this. And how am I going to get another job? And there was some economic elements to it that, you know, he was keeping from me. And I was happy because it was the right thing to do to separate. And the crossroads was, do I really fight for what's mine and make a big deal about this? Or is that going to make it worse? Or do you just run away or run toward the next thing and turn your back to this and just hit the reset button and go? I could have fought and I didn't. And I hit the reset button and I only looked forward. And interestingly enough, the whole reason I'm at Edison is because my now partner was on my board at that company. And he didn't know, like the CEO said the board knew what was going on, but he didn't know what the CEO was doing. And my relationship with Edison and with the board was intact. And then, of course, they find out what happened and the CEO lost their job and I wound up at Edison and could not be happier. So you can be in these tough situations. You have to do what's right for you, but there's just so many other places to go and you just got to kind of like hit reset and move on and get the negativity out of your life. And that's what I chose to do. And karma's a bitch, right? And ultimately, like, you know, I don't want to, it doesn't matter what happened to him. It matters, you know, what happened to me. And I think good things happen to good, hardworking people. And I hope that's why I landed where I landed. So those are two, you know, maybe silly examples, but they are what they are.
Well,
Yeah, they're great
so
examples.
much. Thank you so much. We're approaching our 1 hour mark now. And any closing remarks, Kelly and Maria?
No, I just want to thank you, Kelly. I think it's been great. This has been such an informative talk. I'm certain everybody got a lot out of it. And I know I learned a lot. So really appreciate it, sharing your knowledge with us here at Rutgers CEO Forum. And also in the chat, I think anyone can see the links to our LinkedIn group. We'll be putting the link up for this chat. There's previous chats on our YouTube channel as well. I also included that link in the chat box. And we'd love for you to join us in the future. But thank you so much, Kelly. It's been a wonderful experience, delightful, and so informative. You're just so inspirational. Thank you.
Thank you. It's good fun. Good to meet you all, and great to spend the time with you, Maria and Mukesh.
Thank
Happy
you,
to
Kelly.
do it anytime.
And thank you, Maria, and thank you, Ryan, as well. And feel free to
Ryan.
join the ecosystem on the YouTube channel. Follow the YouTube channel and subscribe to the LinkedIn group, and just grow your own ecosystem. And feel free to connect if you need anything. Thank you so much.
Absolutely. Thank you.
Have a good day.
You
Thank
too.
you.